There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We're going to teach you the processes.
This is what really gives the meat and potatoes to it.
We're going to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for an exclusive trading education event. Sign up now.
Good morning, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the morning call. So yesterday we got a new all-time high in the S&P. It's becoming a familiar tune. I keep writing headlines for the morning call, daily recaps, and it's all new highs, new highs, new highs. Getting a little bit old, but this morning we come in and we have futures down a little bit. Maybe shake things up a little bit from the recent price action we've seen since last Friday's gap down on the jobs number. It's really been a hugely impressive snapback and a swift return to highs for the S&P after that big gap down. Some people thought that really, really weak jobs report might trigger some volatility, some panic, some fear in this market. But as we've seen all year this year, we saw the market rally all the way back to all-time highs and extend above all-time intraday highs as well. So very bullish price action. But like I said, this morning we come in, futures are down about 7 or 8 handles as we saw some weakness in overseas markets. And then we saw JP Morgan and Wells Fargo trade lower after what were actually, they seemed like good jobs reports, or at least decent jobs reports from those banks, but wasn't enough to push them higher. But we'll talk about that in a little bit. Let's go to the chart of the spiders here. And we look at the daily chart, we see that big gap down on Friday that was immediately bought up. During that session, the spiders drifted higher and then accelerated into the close, and then they haven't looked back from there. We saw a little bit of a close off the highs yesterday, but how can you blame the market after that big 4-day run? We're going to take a look at the 5-minute chart just to see where we are pre-market. You see we're about 158.57 was the last pre-market print in the spiders. So we go back to the daily chart and look at that. And we're still above the 8-day moving average and all that type of stuff. But we started to get very extended in the last 2 days from those short-term moving averages. And we always look at that as a sign that we need some rest, we need some consolidation, and we need some of that digestive type action after an impressive move back to new highs like I talked about. And if we go back and talk about those earnings reports that we had this morning, the banks have been a little bit out of play over the last the month and a half, I would say, for the market, as the market has been trading in an upper level range. The banks have been one of those sectors we've been pointing to as a sign of weakness. And you look at JP Morgan, it has been one of the weaker bank names, but has a similar pattern to all of them. This week, you've seen the bank stocks tick up into these earnings reports, potentially anticipating some good numbers from these bank stocks. And this morning, JP Morgan actually delivered a solid report, or what I thought was a solid report, but apparently the market doesn't seem to agree with me. They were basically in line with revenues, they beat on earnings per share, and they actually hiked their dividend up. So now their JP Morgan's dividend yield is 3.1%, which is actually more than the 30-year Treasury bond, which is an interesting thing to note. But JP Morgan down this morning. We'll take a look at the 5-minute on JP Morgan and get the 24-hour look at that. You see it around 48.87 is the last pre-market print. It's down around 0.8% at last check when I was looking at it earlier. And it hasn't really moved much from there. So not a huge sell-off in JP Morgan. It'll be down here near this cluster of moving averages, the 50-day, 8-day, 21-day. It'll be interesting to see what happens during the session. We always look to see whether gap downs or gap ups are bought or sold, and that really can set the stage for composure for a multi-week move in one direction for a stock. So if you see a gap down and trade lower, that could tell you that some weakness could be coming into the banks and particularly JP Morgan, despite the fact that it's becoming an increasingly compelling value stock after hiking its dividend about, I think it was 27%. So, if you're looking long term, the banks are getting more and more compelling as value plays. And Wells Fargo is the value staple within the banking sector. It's a more conservative type of bank. They take less risk, and there's less volatility in the stock as a result of that. It was sort of, it wasn't as weak as some of the other banks in the last month, trading in these upper ranges, but it also ticked up like JP Morgan into the report, but is actually weaker this morning, down around 1.7% after its report. Its report wasn't quite as strong as JP Morgan's, They did continue to grow earnings. Some thought that this quarter might put an end to its long streak of growing earnings each quarter, but they beat by a penny their fourth quarter earnings. We take a look at the 5 minutes, so it continues to bleed lower this morning in the pre-market, so I would say it's probably down around 2% without doing the math, but 36.69, we'll take a look at that level on the daily chart. And we're all the way down here right near this pivot low, so that'll be a very important to watch for Wells Fargo to see if we get more weakness in that. And then the 50-day, if we do get more weakness off this gap down, the 50-day moving average could come into play. So Wells Fargo will be one to watch, but on a long-term basis, Wells Fargo is one of my favorite bank stocks because of its value nature, because of its less volatility, and the fact that it pays a nice yield, and the bank doesn't take as many risks as some of these other banks do. Next week, we'll get a continuation of bank earnings, so we'll just take a look at a few of those charts. You see Goldman Sachs has rallied up into its 50-day moving average. Similar chart to a lot of the other banks. It was in a descending channel, and then over the last 4 days this week, we've seen a breakout of that, and now it has a big test at its 50-day. Take a look, see how it's reacting to those earnings reports pre-market, and it's also down with Wells Fargo and JP Morgan, so something to take note of to see if that weakness is bought today in Goldman Sachs. We're going to move on a little bit and talk about the fact the money, the market is at all-time highs right now, but as last Friday's jobs report told us, the economy is not booming, and especially the employment picture is not perking up the way people would like. We have the lowest participation in the labor force since 1979, so that 7.6% unemployment rate is extremely misleading. And you have basically 15% unemployment, a lot of issues with the economy. But it seems like the equity markets are where people want to be right now. It's sort of the lesser of many evils, is that people don't really want to pile into the bond market with yields extremely low. They don't want to pile into other risky assets. So you're seeing sort of a flight to the more conservative defensive type stocks. Something I talked about a couple weeks ago in the morning call with Brittany is that you're seeing huge moves. If we go to the chart in stocks like Johnson & Johnson, Proctor Gamble, these value staples that people are looking for somewhere to put their disposable income, and they don't want to put it in risk assets, and they don't want to put it in riskier sectors within the stock market, so they're parking it in these conservative high yield type value names. And then with those names somewhat extended, it seemed like earlier this week people said, okay, we have a stock like Microsoft that is sitting on a pile of cash, has a little bit of a yield, and it's also a tech company, even though its role as an innovator is diminished over the last several years thanks to some faulty leadership from Steve Ballmer, who probably needs to step down, but that's a conversation for another day. But you saw Microsoft with a huge move as people started to rotate money into a stock like that, and then what do you get? A huge smackdown. That's really harsh on anyone who's buying this breakout in Microsoft, is that you saw PC sales come in weaker than expected, and then you saw, due to that, Goldman Sachs put a very negative downgrade on Microsoft, and it erased that 2 days of really bullish price action, and Microsoft is down again with the market this morning. Just something interesting to note. Intel, similar situation, but less harsh. It had a 2-day sharp up move, and then on that Goldman downgrade, it traded down and erased that 1 day of gains. But then yesterday, it held up better than Microsoft. So Intel is one that you could continue to see some bullish price action. But the point I'm really trying to make is that you're just seeing money continue to rotate, and there's no sign that the indices and the broader markets are going down anytime soon. I know we have weakness this morning, but every time I am somewhat bearish on the market, it seems like it rallies, or anyone's somewhat bearish on the market, it rallies. But I still think there's a lot of red flags. But if you are going to continue to put money into the equity markets, I don't think you chase strength in sectors that have been strong leading up to this point. I think you look for sectors that provide a little bit better risk-reward type parameter. And one of those that we highlighted a little bit in off the charts last night is the oil service sector. The OIH is the ETF for that group. And you look at a nice descending channel you see in the OIH. We'll draw our lines here. The one we highlighted in off the charts was Halliburton, and I'll pull that up in a second. That's a very similar looking chart to OIH, but the OIH pulled back into its 200-day moving average and has rallied impressively over the last week plus. On Friday, it was one of the sectors that led us off the lows. And then this week, you've seen it climb back above its 8-day, 21-day, and 50-day moving averages. So it's a sector that I think you could see money rotate into it. There's a lot of factors that come into play with oil prices and oil service stocks, but something to keep an eye on. We'll take a look at that Halliburton that was listed on off the charts last night. Exactly same type of pattern. I didn't even trade down into its 200-day moving average, but now you're seeing it climb back above the 8-day, 21-day, and 50-day. So something to keep an eye on as money rotates. And in general, a concept that I like to hammer is the idea of brands, strong brands, and during corrective phases and stuff like that, and during markets like this where you're seeing a flight to safety, I think putting your money into strong brands is a very attractive thing, because in any recession or any type of volatile environment, brands are the things that are going to emerge and are going to stay strong. They're not generally going to go anywhere, and I'm talking about the bedrock brands, and one of those has become over the years Nike. And that's a pattern that on Friday's gap down, I did the morning call that morning like I do every Friday, and I was talking about my favorite setups on that gap down, and I talked about have a very narrow focus, but I think Nike has a tremendous upper level pattern and would be my #1 play on this gap down. That was last Friday after the jobs report. And it wasn't a blockbuster after that jobs report, but it stayed in this upper level base after earnings. We love to see a stock that reports good earnings, gaps up, and then trades higher from that gap and puts in a base, and that's exactly what we saw with Nike. And then you had a beautiful upper level wedge here that you could base this trade off of. That we got a tremendous move this week, a great extension yesterday to give us some more return on that trade. And this is one that maybe it's a little bit extended on the short-term basis, but if we do get a pullback into that 8-day moving average, maybe if you want to be on the long side, this is one that you test. But this is one of my favorites, an extremely strong brand. Another one that I really love is McDonald's. Obviously, everybody knows about McDonald's. It doesn't have really a compelling pattern here, but it's another one that if we do get weakness, a pullback into the 21-day, especially if we get down in the 50-day area, which is, getting ahead of ourselves a little bit. But these are the type of stocks that if we do get a pullback, this is where I would want to be putting my money. Strong brands will continue. Proctor Gamble, consumer staples. It's one of those value-oriented names that I've been talking about. We highlighted out of this base as a breakout and off the charts, and I talked about it in a couple morning calls and daily recaps. We got a nice push, and then we got another little base here. And then the last 2 days, we got a breakout of this mini base. So a couple good moves in Procter & Gamble, depending on your time frame. A couple good cash flow trades in what's supposed to be just a value stock. But that's what we're seeing a lot across the board in this market. And then the last one I'm going to talk about, which I think does have a compelling pattern right now, is Starbucks. Starbucks, obviously everybody knows Starbucks, like all these brands I'm talking about. But it's one that traded down into its 200-day moving average here back in late February, but has rallied back up to highs. It's at 52-week highs here as we zoom out. Still under all-time highs, though, so that gives you a little bit of optimism that it could have some room. It's not completely running away from us. And you have a nice upper-level base that's formed here in Starbucks, and it's really done a good job of holding its 21-day moving average. You see some tails here that it's tried to trade below it, but you've found buyers every time we've gotten a harsh down day in Starbucks. And yesterday it started to break to the upper end of this little pivot, and I think we could see a break above that. I mean, futures are down this morning, so it might not happen now, but this is another one on some weakness. I think this is one that would be a good place to look to buy. We're going to look at Facebook, which was the second one on Friday's jobs number. I basically said they're on that gap down that morning. I said there's two stocks that I really like as negative to positive trades today. The first one was Nike, as I talked about, and the second one was Facebook. And the trade didn't exactly, on Friday it played out very well. As we go here, we'll look. It was this candle, I believe, was Friday, yep. So we had April 5th here, this Friday. It was very blockbuster trade that day, but then the first 2 days this week, Monday and Tuesday, we saw weakness in Facebook, trade back down into its 8 and 21-day moving averages. But then the last 2 days, it's perked up and started to act much better. And it's now above its 8-day, 21-day, and 50-day moving averages, coming into a pivot right here. Could Facebook finally get going? That's the eternal question, but I think Facebook Home is a step in the right direction. Some people thought that maybe they would come out with some phone hardware, and Mark Zuckerberg has made it very clear that that's not in his plans for Facebook. But I think the Facebook Home concept is a good happy medium, and it really brings the Facebook experience into someone's phone more directly, and I think that could be a catalyst for Facebook to maybe challenge those pivot highs up at 32. So we'll keep an eye on that one, but Facebook is tough. It often has a tough time holding up after small rallies. The healthcare sector is one that I think is very, very compelling right now. You saw it was a ruling on how Medicare payouts are done that really sparked this big move in stocks like UNH, Humana, UnitedHealth, which is one that Warren Buffett owns, which always adds conviction. But you saw a big move in these select healthcare names that have a big exposure to Medicare and things like that. And if we look at the chart of UNH, it has held that gap up very nicely. And that's sort of like on an earnings report, is that on a big news report, you like to see a stock hold its gap up and put in a base to potentially allow you to base a trade off of. And UNH has done that very nicely. Yesterday, it looked to be breaking above this little mini range. This morning, look at the 5-minute chart on this one just to see, not printing much this morning, so we can't really tell, but it could be down a little bit with the market. But this is one that I think you could see some upper level continuation after the gap up. And the healthcare sector in general is undergoing a big shakeup due to Obamacare and things like that. And I think a lot of those changes are going to be bullish for these healthcare stocks. And if we zoom out to even the monthly chart on UNH, you can see it's coming into a huge level. Basically 2005 highs are all-time highs in UNH, and that's what we're challenging right now. And on a macro basis, as I look at this monthly chart a little bit closer, what it looks like to me is a reverse head and shoulders pattern. So if you're looking for a long-term place to put your money, I really think that the healthcare sector could see a big move. As you see, I draw this sort of fugazi head and shoulders here with my lines. The right shoulder is not perfect, but you get the idea. And it looks to be breaking that. You have the neckline up here. So very interesting pattern in UNH, and I think could be a long-term winner. We'll take a look at Humana, which is another one that's been strong. After the gap up, we'll go back to the daily chart to look at that. After its gap up, it didn't hold quite as well as UNH, but it still held most of that gap. And you can almost consider this green bar part of the gap, because I think the news got out about that ruling on the Medicare, and it caused all these healthcare stocks to have a huge run. If you remember that day, it all happened late in the afternoon, so I think people got a little bit worried of that. But it's still holding the majority of that gap if you consider it a gap. We go out to the monthly chart on Humana. It's not exactly as compelling a pattern as UNH. I like UNH better personally, but Humana looks like it's one that could have some room to the upside. We'll go through a few quick hits, and one that I really want to talk about is one that I've been talking about in most videos that I've done recently, is gold. And you have a lot of people asking me these days, is gold a buy here? You have all this fear-mongering about the Federal Reserve creating potential inflation in the future and destabilizing world markets and things like that. But the question is, why is gold not ticking up with all these quantitative easing programs that are being introduced? You have Japan introduced a $1.4 trillion unprecedented easing program recently. You sort of have currency wars. It's a little bit of a buzzword that you're not exactly seeing the conflict as far as currency wars go, but you're seeing a lot of countries devalue their currency, hoping that'll help them escape a recession or a deflationary spiral in the case of Japan. But you see gold pre-market this morning and is down sharply. It's off of the lows pre-market. It was down around 147.50. But this price action in gold tells me that there's some big player right now that's looking to unload a large position in gold. Whether that's a central bank or a big gold fund blowing up, who knows? It's hard to ever know, but this is something you really need to take note of, and gold is challenging macro support. If we go back, we'll look at the weekly chart. You get a better look at that. You have macro support here. The low of this candle, 148.27. The low here, 148.60. So that's right around where we have gold set to open this morning. So it'll be very interesting to see whether you have interest on buying the dip in gold and about what happens. Because if we do break that macro support, I think you really could see the 200-day moving average definitely around the 139 or 140 area, I guess, in GLD. But something really to take note of. I think, generally speaking, I've talked about this before, is that if you zoom out, you can make a compelling case that gold is simply digesting after a huge decade-long run. But gold, to me, as a long-term bet, is a little bit risky, because right now it's very clearly just a fear trade. And once that fear disappears from the market, and you're starting to see that as we've rallied, over 10% so far in 2013 in the S&P, so you're starting to see some of that fear dissipate. And when you get that scenario, it's a dangerous situation for gold. And I think you could see a lot of gold. If you have gold funds and funds that are really heavily invested in gold, they could be in a lot of trouble, and it could cause some situations like we're seeing this morning with gold down huge if we get some blow-ups in those type of funds. Another one I've been talking about recently is that when a rally gets into its late stages, you oftentimes see stocks with large net short interest be the most compelling setups because it's hard to find buyers to really push stocks higher when there isn't a short squeeze in place. But when you have a huge short interest, you can get those short squeezes that it's simply short covering rather than new buyers piling into stocks at upper levels. And one that I tweeted yesterday as it started to break out of a sort of mini upper level base here was Tesla. And Tesla is, when you talk about highly shorted stocks, this is maybe the poster boy for it. A lot of naysayers for Tesla as they don't think that electric car model is going to be a long-term winner. But yesterday you saw a nice move in Tesla. It did close a little bit off his highs, but you have almost a 50% short float in Tesla. And that's the mechanics of that trade tell me this one could really explode at some point if it gets some momentum. You have pivot highs here from these two candles that are your 2 points of reference to watch. If it's down this morning with the market, which it could be, you'll have yesterday's high and yesterday's close as two pivot areas. But Tesla is one that I really think is a compelling long after it started to become a profitable company in the most recent testimony from its CEO, Mr. Musk. A couple other quick hits. Netflix is another one that we've always talked about as one with a high float short that can trigger short squeezes. And last night we got news from Reed Hastings, the CEO, that there was 4 billion hours of usage for Netflix last quarter, which was higher than expected, which is very bullish for the stock. And you're seeing it up pre-market, or at least it was last night. We'll take a look at it here. So here you have it at around 177 pre-market, a little bit off of last night's highs, but still a nice up open and a down tape. And so I think it could be another situation that I had talked about shorting Netflix out of this upper level base. But in a bull market, you don't want to have your expectations be too high for short setups. So I think you should have been looking to cover some shorts if you made that play after 3 harsh days down. And now you could see Netflix squeeze some of those shorts that are still hanging around this morning as we see the market open. But that'll about do it as we head into the market open. Volatility is good for the market, so hopefully we see today's gap down spark a little bit more action, loosen things up a little bit, and allow traders to hopefully create some alpha. I will see you in the virtual trading floor today.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.